Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with your resource, Grand Rapids, for a common sense approach to the decisions you're making with your money, your finances, your investments, and retirement accounts. He is Ron Corser, CFP, founder of Cornerstone Retirement Partners. Ron, we always appreciate the time and the guidance and perspective that you provide to Grand Rapids area savers and investors.
Good morning, Peter, and good morning, everybody who are listening to today's program. If you're on the way to church, drive carefully, be kind to others who are not as good drivers as you, and pray for them a lot because they need it. Well, we're going to have another, what I hope to be a good program. I always think they are. But I wanted to start today's program by just touching a little bit, if I may, about some of the emotions, the mentality that I'm sensing from our clients and from people I just talk with. We're in uncharted times and uncertainty, it seems like. One of the things I tell people is that, and anybody listening to today's program, one thing we know is that everything always changes. Change is always with us. That doesn't mean we have to like it. I'm always reminded of an old Charlie Brown cartoon that I saw where he's talking to his favorite nemesis. And Charlie Brown says, or she says, I like change. And Charlie Brown says, well, I do too. And she says, well, you go first then, Charlie. And a lot of that has to do with who's going to go first. But there's a lot of uncertainty. Right now, there's a lot of, I'll use the word fear just because of the uncertainty. And I'd just like to say a few words about that. We live in Michigan, and right now, here it is towards the end of May. We're hoping that spring has finally sprung and it's here. But we're not sure, but we're hopeful. We know that ultimately it's going to change and we'll get some variation of global warming or summer, whichever comes first. And a lot of what's going on in the world is the very same way, particularly as it impacts the stock market, which is on everybody's mind right now. We've got an economy that seems to be in free fall at worst and just confused at best. We have uncertainty in the political system. We have uncertainty in the world around us. Things are going on that a lot of us just don't understand, and things are going on that a lot of us simply don't like for any number of reasons. And I tell folks, let's look at it and think about it, the change of seasons in Michigan. We know, for example, that spring is supposedly coming. Summer's coming, it's going to be warm, it'll be fun, hopefully. But ultimately, we know that a winter season is down the road somewhere. So sometimes people say, well, there's a lot of volatility in the market. What are we going to do? The market's going down. What's the right approach? I kind of want to take a 10,000-foot view of all this. The right approach is one of those that we don't know if it's the right approach until we look in the rearview mirror about a year later and see if the decisions we made sense. If they made sense and we either didn't lose a lot or we made money, seems like that was a good thing to do. But we don't know that. We're always flying blind, so to speak, into the future. And a couple things that we all have to hold on to is, number one, this volatility, though it may seem extreme, is in the great scheme of things, it's somewhat normal in a very crazy way. It's somewhat normal. We've gone through some terrible times in this country. We really have, going all the way back before even George Washington's time. And we've seemed to be able to navigate this over time. So I guess the message that I say to our clients and those listening to today's program is be of good cheer. This is probably going to change at some point in time. We just don't know when, and we don't know what it'll look like or taste like. But hold on to the positive things. Number one, America is still a really great country, regardless of what some people think or what other people say about us. We are truly a great country. Now, there's a difference between the United States government in the American people. The American people are some of the most generous, creative, loving people in the entire world. Our government, you could argue not so much. The American people are really an incredible group of people. A lot of us still have the idea that if you just pay attention to the rules, you work hard and do your best, you can make progress. It's not the end of the world like a lot of people are talking about. And the same thing goes with investing in the market. Right now, there's an enormous volatility, there's enormous uncertainty. We all have a sense that the adults in the room have no idea what they're doing. And to that, I would say, I probably could make a case that there's a lot of truth to that. But we still have a very resilient economy. It's being battered and beat up, but it's still the best economy in the whole world. Some of the things that we've done over the last 15 or 20 years in terms of our economy have come back to kind of bite us, haven't they? The supply chain issues, everybody trying to work from home on a laptop. I still don't know how a plumber does things on the internet. And, I guess you could do a YouTube on how to fix something. I don't know how a guy comes into your house and fixes the electrical system. I don't know how he does that on the internet, but apparently it must be possible. But there's still a need for people who can do real things, who can make a real difference in your life. And as investors, as parents, as grandparents, we still have a great opportunity to prosper in the future. What we have to do is just take into consideration what's going on around us and not, so to speak, go on that tightrope walk across the Grand Canyon without a parachute, 3 kinds of other safety lines and everything else to protect us. As an investor, as a citizen of the country, I think that the future of our country is really good. Are we going to go through some more tough times? Absolutely. We've got a lot of things to kind of fix, a lot of new ways that we have to start thinking and valuing the human being just because we're created in God's image. So the markets are volatile. People are a bit uncertain, concerned, maybe fearful. I get that. I understand that. But there's a way to approach the markets, just as where there's a way to approach the changing seasons. There's a way to approach the uncertainty in our lives. As we start to sit down and rationally take a look at it and plan for it and do the what ifs. What if this happens? What are we going to do? What if that happens? What should be our approach? How should we think about interest rates going up, mortgage rates going up? How should we think about inflation? What can we do to protect our lifestyle? Because protecting our lifestyle involves protecting our investments and our life savings. So I just want to tell everybody today on your way to church, maybe pray for us. We're going to be okay. I think ultimately we come out of this morass that we've been in for about the last decade. We probably have another decade to go, but I think over time it'll get better because there's a fundamental goodness in this country that they still can't stomp out or cover up or eliminate. And that's where I think our saving grace comes from on a human perspective. So we're going to talk today about some of the things we can do, perhaps how to look at the markets, how to look at the economy, how to think about some of the things that we've been told or we think are solid rock and cement kind of ideas and investing to see if they really are true. Because ultimately what we want to do is we want to get through the next day, the next week, the next year, and the next decade with our lifestyle intact. But ultimately with the understanding, and my wife and I talk about this, I'm very concerned for our kids and our grandkids, especially my grandchildren. I really worry about them in this world that we're in. But my wife, Nancy, and I have decided that we're the ultimate backstop for our kids and grandkids. It's really important for us to be foundationally solid, to not do stupid stuff, because ultimately we're the fallback for our kids if they run into trouble, especially our grandkids who may need help. I've got a grandson who's got some developmental issues, and God's blessed us with enough money to be able to help. So we're able to help out that way. And I think for the listeners out there, the parents and grandparents, the number one rule for investing is to stay fundamentally sound for yourself. because ultimately you may be the one and only place that our kids and grandkids can come running to be kind of sheltered and safe in a physical sense in this world. So we're going to talk about that. We're going to talk about how to deal with all this craziness and some of the good news that's potentially out there for us as investors.
Ron, I think that every decade, every generation has some moment where they think, oh, this is it. We are on the precipice. This is kind of the edge of oblivion, and it could all end tomorrow. And then life goes on. So the theme of what you just said, what I'm taking from it, is that yes, we can be aware of and concerned with the events of the day, but we still have to plan proactively for tomorrow and as if life is going to go on, so that when we get there and eventually tomorrow comes, we are prepared for it.
Yeah, that's a very good way to just summarize, I guess, what I've said. The world is always changing. It's always going to come to an end next week. The zombies are going to come out. And if we listen a lot to the media, we probably only got about a day and a half to live, don't we?
It seems that way on most days, yes.
So I tell people is let's just step back. If you've gotten this far, you've made some good decisions in life.
Yep.
So let's focus on those. Let's see if they'll still stand up to what we think is going to come down the road. Nobody really knows, although we think it's going to be kind of bumpy. That's probably a pretty good assessment. But let's see if we can make some sense out of it going forward, talk about market corrections, what they are or they aren't, how to respond to them. Ultimately, whether the markets go up or down isn't the ultimate question we have to deal with. It's what are we going to do about it? How are we going to respond to markets going up, down, or sideways? What are we going to do about it? So that's what I'd like to touch on in this program. Stay tuned. If we've already kind of piqued your interest, I appreciate that. Give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and number in there, and we'll reach out to you and provide you the information you need to make really good decisions going forward with your financial future.
Cornerstone Retirement Partners, your resource, ladies and gentlemen, for planning proactively, for achieving your important financial goals. And if you'd like the help and assistance of Ron Corser, CFP, and the rest of the team at Cornerstone Retirement Partners to help plan proactively for your wealth and health, pick up the phone, give them a call, 616-301-2581, 616-301-2581. Now, Ron, putting what you just said into a financial perspective, I do think that it is valid that a lot of savers and investors are concerned about the economy. I mean, we have seen more jitters to begin 2022 than we have seen in really most of the recent decade to decade and a half. And that is causing worry. That is causing angst and anxiety. Now, you put it in a historical perspective and said, in the grand scheme of things, downturns are a normal occurrence. But do you think it's because we have not seen a lot of volatility, the unusual absence of downturns over the last 10 years or so, that is causing people to worry about current conditions maybe more than they otherwise or normally would have?
That's a great question. I'd answer it this way. For those of us who've been around the block a few times, we go back to even the late 90s when the markets were really good. And then we experienced, and a lot of people out there, you experienced that correction in 2000, 2002. Then things got better in a hurry. And then the world came apart with a correction in 2008 and 9. Since then, the market basically has gone up. So for folks like us that have a few years on us, we remember those times. And we're perhaps a little more cautious, but we also understand that even in the bad times that we remembered, which were horrible, particularly 2008, we did come out of that. Hopefully we didn't have too big a loss in our life savings. to destroy our retirement plan. For somebody who really has just started investing in the last 10 or 15 years, particularly the last 10, there is no historical sense, if you will, about what markets can do. You know, in history, we've had about 16 bear markets. What is a bear market? That's basically a market that's gone down at least 20%. They've averaged about 39% downturn. They last about a year and a half. And sometimes it can take anywhere from 2 to 5 years to really recover from that. Our most limited experience and recent experience has been what happened in COVID in March of 2022, when they shut everything down, or 2020, when they shut everything down. You know, we had a really great market in 2019. January seemed to be on another roll, and then all of a sudden the world changed. This COVID thing created a lot of uncertainty, created a lot of strange government programs. They ultimately shut the whole world down, which seemed to destroy a whole lot of things that shouldn't have been destroyed. The market went down dramatically. The market was down in the first quarter 22.1%. But in March, when they shut everything down, the market went down 31% in 11 days. And nobody knew what that was going to be. I thought that might perhaps be the beginning of another bear market. But what did happen? The government absolutely cranked up the printing presses to about from 35 miles an hour to 135 miles an hour, and threw more money at it than we knew how to spend, and it bounced back. We still know today, though, that we have real fundamental problems, don't we? In the markets, we have supply chain issues. We perhaps have, I feel sorry for the farmers and they can't get fertilizer. We may have a worldwide food problem shortage this year. We don't know that yet for sure. So there's a lot of potential problems out there. So the things we're living right now are real. But when it comes to long-term investing, sometimes 3 weeks ago is history and yesterday was the future. So it's always important to have perspective. But what I can tell everybody, these are the times where you really need to sit back and say, I wonder if I really understand how much risk I have in my life savings, in my investments. How much risk do I really have? If this market keeps going sideways or down, what's going to happen to my accounts? The second thing they need to answer is, or ask is, okay, let's assume that the volatility we're experiencing is going to stay with us for a while. What are we going to do about it? What can we do about it? And there's two approaches. One is buy and hold, don't worry, the market always comes back. And in long term, there's truth to that, isn't there? Because the markets always came back. The collapse in 1929, the Great Depression, that also came back with World War II, about 18 years. What happened in 2008 came back in about 6 years. So the things do come back. The question is, what are we going to do today and how is it going to impact our lifestyle? So ladies and gentlemen, if we're touching on something that's kind of touching a hot button with you and you want to talk more about it, need more information, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and information in there and we'll reach out to you just as quickly as we can to help you.
You're not speaking about insignificant amounts of time, though, Ron, when we're losing maybe 3 or 4 or 5 years for a bear market to sort of work itself out and find its way into recovery, where the market meets or surpasses previous highs. We've heard that the market always goes up over time or always comes back, and it has. It has not only come back from these previous downturns, but surpassed previous highs. But that amount of time in the meantime, and then where we are at in our time, really can help us to determine what the right approach is, or determines what the right approach should be, correct?
It is. And the other thing that's important to realize is that when you're putting together an investment plan, whether you're 30 years old, 60 years old, or 90 years old, you need an advisor to sit down and help you say, what are the things we need to be concerned about on a personal level, but what are the things that lurk out there, so to speak, in the economy that could have an impact on our life savings? And if it has an impact on our life savings, it may have an impact on maintaining our lifestyle going forward. So what are some of those things? And what I try to help folks understand is that just like we can plan for summer and fall and winter in Michigan, you can plan for those kinds of seasons in the investment world. It's important to understand that there is a seasonality to investing. Don't bet the farm on it. We just know it happens. So if somebody is 10 years away from retirement and they're looking at today's market thinking, oh my goodness, one of the concerns might be, well, I've lost a little bit of money. How am I going to make it up? Another concern might be, well, maybe I should just get out of the market and put it in a 3-pound coffee can. Another concern might be, well, this is a dip. I think I'll buy the dips and invest more. So those three options, which one's correct, Peter?
I would say it depends. Any of them could be correct depending on what we want to have happen with our money. I suppose to me, locking in losses at this point in time because of where I am at in my personal timeline and time horizon does not seem to be the best approach in my personal opinion, but I'm not everybody's situation. So there may be others that don't want to continue to take the risk of the market or have the time horizon to wait and see if things come back or when they do.
Well, if I was a teacher and you, my student, I'd give you a gold star for that. It gets down to this. We're not interested in locking in losses, so to speak. But how about the concept of, we're in a rising interest rate environment. We've got a lot of inflation to deal with. And maybe you have a substantial bond portfolio in your life savings. In a typical 60% stock, 40% bonds, maybe the bond portion of your portfolio is really suffering. And with the Fed continuing to promise to raise interest rates and inflation just keep going up unabated, bonds are already struggling. How much further can they struggle? So in terms of locking in losses, perhaps a better way to look at it is to say, is there something in my portfolio that is really not responding well at all to the current environment? And can I or should I, or does it make sense to reallocate away from what's really struggling into something that has a better opportunity or potential to make money? So if you own, as the saying says, if you own good stuff, be very careful not to sell it. But if that stuff you own, particularly in the fixed income sleeve, is not performing well, and you believe that that stress is going to remain there, then maybe it makes some sense with your advisor or give us a call to rethink how much you want to put in that particular investment category, that strategy, because that may be a really wise way to deal with what's going on around us.
Ron, I think that is one area where a lot of us lack that expertise, though. And one of the big reasons that people probably turn to financial professionals and to you and your guidance is I don't feel like many are able to just open up their 401k statement and readily identify what is a keeper, what we should get rid of, and what may be pulling our performance down, what is helping it, or make those important selections. But you've got a trained eye to help spot underperforming assets within the portfolio. You've got software and programs that can help you even further by running some detailed analysis on certain funds or investment choices and options. You really walk your clients through that selection process and building and constructing the portfolio and then reviewing it on an ongoing basis for exactly the kind of opportunities that you're talking about here, correct?
That's a good point to bring up. Yeah, we can do that. It's very important to understand what you own. Now, that doesn't mean if you have a mutual fund with 400 stocks in it, you need to know each one of them. You just need to know what you own, the kind of things you own in a particular investment. But when it gets to certain categories, we do know for right now that the whole fixed income or bond category is struggling. So that may be the first place to take a look at and say, number one, is there something I should keep because it makes sense going forward? Number two, are there some things that I maybe should get out of the way of? Number three, how much should I allocate to this particular part of my portfolio, this whole fixed income thing? And when it comes to 401ks, it's really hard because most 401ks have very, very limited options in terms of where you can go to get out of the way of something or to take advantage of something. But we can help people create it in their 401k, give them the best kind of advice we can, not as being a 401k advisor, but just say, you might want to think about this. To say, let's take a look at the bond part of your portfolio. You know, in some of these yearly kinds of, 2025, 2065, those calendar kind of investments that people have.
Like the
It's
target
interesting
date
when
funds.
when you get into some of them and you see how much the bond parts are and how well they're doing or how not well they're doing. And sometimes you can help them rotate away from that if they're not doing well to protect them. But in this environment, you can say, well, there's no way to run. I might as well just sit where I am. Or you can say, is it time to make an adjustment or two? I mean, even Warren Buffett makes adjustments to his portfolio. So why do I hear so often that, just stay where you are, buy and hold, and you're going to be okay? You're going to be okay, and it's true until something doesn't work anymore. And then you're not going to be okay. So if Warren Buffett and these other people can make changes in a portfolio, why is it so almost like a sin to take a look at making changes? It just makes sense to me. So ladies and gentlemen, if just looking at your own portfolio to get an objective third kind of viewpoint of this, give us a call, 616-301-2581, 616-301-2581. We'll help you take a look at what you have to gain clarity and understand what you own, and also to maybe be able to help you say, well, here's some other options that you might want to consider that could perform perhaps a little better going forward or protect you more, whatever your goal is. So give us a call at 616-301-2581. Go to our website, www.cornerstone-rp.com, and we'll help you.
Great conversation with Ron Courser, CFP. We're talking about market volatility, what we are seeing in the markets, what your approach needs to be. We will continue that conversation after the break. And I want to talk a little bit more about those bonds and the fixed income side, Ron. You've mentioned that several times that they are struggling. What is an investor to do when what has been the more conservative side of the portfolio traditionally, that's the side that's struggling? So when we come back, we'll talk about that. We'll take a little deeper dive in, and we'll talk about some solutions that are available to you, ladies and gentlemen, to make sure that your money's working hard to help you achieve your goals with Ron Courser here on Your Course to Retirement. Quick break. We'll be right back. And welcome back to the program, Your Course to Retirement, the weekly show with Ron Courser, CFP, founder of Cornerstone Retirement Partners, your resource, Grand Rapids, for a common sense approach to your planning and the sometimes difficult decisions that we have to make with our money. The complex financial world can be a little bit confusing, especially when we maybe don't have all the answers or don't know what we don't know, or we're just paying attention and get overwhelmed by everything that we are seeing and hearing, which I think is where a lot of people are right now, Ron, with their investments, is that we're a little nervous. We're a little apprehensive. We've got some anxiety about what we are seeing with the market, this volatility. Now, during the first part of the program, you mentioned that the bond side of the portfolio, or fixed income in general, was struggling, and given the interest rate environment, may continue to struggle. The question I have is, what is an investor to do when what has been the more conservative side of the portfolio is struggling like what we're seeing?
That's a great question. And I'm not going to get wishy-washy in answering it. I'm saying they're all alternatives to bonds. There always have been alternatives. It's just a question of when you might want to use them. So what's the purpose? Let's get back. What's the purpose generally of putting bonds in a portfolio historically? It's to generate income and to minimize some of the downside volatility from the stock market. So if those two things are still the important considerations for using bonds or bond type investments, let's take a look at the realistic data. Number one, can you make decent income peel off it from bonds? It's pretty hard to today, particularly if you bought these bonds a year ago because interest rates have gone up and you've experienced some losses. But if you buy a bond right now, a 30-year Treasury bond, it'll produce a little over 3%. That's not too bad. If you have shorter term bonds, they have a positive rate of return if you buy them now. The difficulty potentially for buying bonds right now is that interest rates could continue to go up and the value of the bond go down. Remember, the principal on a bond is almost inversely related to interest rates. It's like a teeter-totter. When interest rates go up, the value of the bond goes down. When the interest rates go down, the value of the bond on the secondary market goes up. So bonds are still pretty spooky right now. So if you can't get a lot of income out of it, how about the second part? Do they kind of buffer the downside? Right now, there's some 7 to 10-year Treasury bonds and 3 to 7 that are down 7, 8, 9% right now. So if you've got a good position on those in your portfolio, you've experienced some losses. So the two questions that need answering is, does the bond portfolio and my investments give me good income, and does it buffer the downside? Maybe the answer to that is not so much anymore. Maybe it's not doing a good enough job. So where can we look? Well, we can look at banks, right? And see what the CDs are paying. That's not much better, but the advantage of a CD is your principal isn't going to go down. So that's one option, and the money's guaranteed. Another place to look is with income producing annuities, principal protected annuities. Now, a lot of people go, oh my goodness, I don't want to hear about that. But they can be a really good bond substitute for some people who need income and also principal protection. So that's another option. A third option, and you can actually invest your accounts to move away totally from credit or income risk, is to create a portfolio with some part of your money that will have a hedge on the downside in the market that will give you some downside protection. This may be appropriate for some people because if you assume that ultimately the markets do go into positive territory somewhere down the road, if you can protect by hedging the downside, even if the markets take away some of the principal, you have a protection put in there that makes it easier for you to recover and perhaps even avoid a substantial or statistically significant loss in your portfolio. So there are options for folks out there. We just have to be able to talk to them and explain to them what they are and how they work to see if they make sense.
Well, if you would like to have those conversations, learn about those alternatives, those options that are available to you, ladies and gentlemen, Cornerstone Retirement Partners is your source. Pick up the phone, give them a call, 616-301-2581, 616-301-2581. There has been a lot of chatter in the financial world, Ron. There has been a lot of research. We've done interviews with folks that have really stated that the fixed income side, bonds and bond funds, not only is currently, but will, as long as interest rates continue to rise, which the Fed has said that is their stance at this point, as long as that is the case, will likely continue to struggle. So identifying that now or as early on as possible, where we've got exposure to those potential headwinds, probably is going to be beneficial. And that's, I think, one of the myths of the market, Ron, is that for many years, decades, for generations, it seems like investors have thought that conservative meant safe, that bonds or bond funds, because they were more conservative and typically less volatile than their counterpart stocks and mutual funds, that they were to be considered safety. But they're not. They have risks associated with them, as we are seeing in today's economy. Kind of just a different environment.
Yeah, bonds are not safe in terms of being 100% principal protected. Now, I always tell folks this little story. I say, do you know what the safest investment vehicle in the world is? So when the world comes apart at the seams, like happened in COVID, where do all these financial institutions, these foreign countries, where do they go to rush to put their money?
The American dollar.
That's true in the form of treasury bonds. I say, so in the great world, the safest investment, I use safe in quotes, the safest investment is the United States Treasury bond. Now that should bring a smile to your face, because the United States economy and our Fed, the way that we print money, it's almost insanity. And we think, well, that can't possibly be true. Well, I tell people the American dollar is the safest investment out there, safe in quotes now. It's as if we're the really best house in a really bad neighborhood on the south side of Chicago. That's about how good it is. And as long as the perception out there is that the American dollar, the treasury bond, is still principal safe in their manner of thinking, we're probably going to be okay.
As the saying goes, backed by the full faith and credit of the U.S. government, right?
Absolutely. And you can always trust the government. Remember what Ronald Reagan said, hi, I'm from the government. I'm here to help you. That should frighten everybody to run out the back door. So you have that. But it gets down to a more fundamental, there's a more fundamental idea to think about here in this time. And there's an expression in our industry that you don't know who's swimming naked till the tide goes out. And we're in that situation now. We've got a really volatile market. It's down since the beginning of the year. People have some losses in their accounts. We don't know how much risk we have until we start seeing our statements. But it gets down to a really fundamental issue. With all the volatility, with markets going sideways and down, how stable is your retirement income plan? How stable is your retirement income plan? Here's a key question for everybody to answer. If the stock market goes down another 10%, will that impact how you take money out of your retirement plan to pay your bills, go on vacation? If the answer is yeah, if the market goes down, I lose another 10%, I got to start cutting back, then the real problem is that the income plan that you did or didn't produce, that your advisor didn't help you with, is not working correctly. And maybe that's where you start to look to say, what can I do in this environment? What do I mean by that? When we help you, ladies and gentlemen, create an income plan for retirement, our goal is to create cash flow from all your different accounts coming in every month. That's the most permanent possible way to do it, so that it doesn't matter if the markets go up or down or sideways. Every month you have all the money you need coming into your checkbook to pay your bills, have a little fun in retirement, do what you want to do, spoil the grandkids. If your income plan that you have right now would suffer if the market went down another 10%, that's a real good sign that perhaps you need somebody to help you make an adjustment in your income plan, in the investment stuff that's creating the cash flow. Because ultimately, nobody knew 2008 was going to be as bad as it was. So if your income plan can't survive something like that, maybe you need somebody to take a look again at what you have and how you're doing this income and retirement issue, so that you can put a little more stability into it, a little more confidence into it, and a little more peace of mind into it, so that, you know what, next month, 6 months from now, I'm going to have all the money I need to keep my retirement dream in place, and I'm going to be okay. So ladies and gentlemen, if this is important to you, if we've talked about something that's kind of touched the soft spot with you or a hot button, whichever way you want to look at it, give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name in there, what you need, we'll help you. We can help you take another look at, is my retirement income plan, is it going to make it? Is it going to be okay? We actually do this work for our clients, even they've been with us for 15 years. We actually periodically say, let's just take what you have now, your investments, and the money you're spending, where all the money's coming in, and let's see how long it'll last. We can actually put a day on that, so to speak, as to how long your current plan will last, knowing that, you know, as the world changes, we always have to make some adjustments to the retirement income plan. And that's what we're good at. That's what we help. So ladies and gentlemen, if you just want to know if your current plan is on track and will stay on track over the next 10 or 15 years, give us a call. We can help with that analysis. 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you, provide you what you need, help you make great decisions, and brings a little more peace of mind into your world today.
I think that's one of the best parts of the services that they do offer there at Cornerstone Retirement Partners, stress testing the portfolio, putting it through different situations and scenarios, examining the assumptions that your plan and your financial future are based upon so that you can see what the potential outcomes look like. And you can maybe identify where there are stress points or cracks in the current plan, and then choose to discuss the options for how to address any of those weak points in the plan. That conversation alone, so valuable in adding and instilling confidence moving through good times and difficult times in our economy and into our financial future. That is part of the initial review, the complimentary strategy session that they offer there at Cornerstone Retirement Partners. If you'd like to take part, take advantage of that offer, pick up the phone, give them a call, 616-301-2581, 616-301-2581. Now, Ron, investment in the market is a valuable tool, and those that have done it over time, by and large, have benefited from it during our working career. The paycheck supports our standard of living, and then we have our investment plan going on the other side. You've got this list of 7 financial myths, and I think that you're hitting on one of the good ones here. One of the ones that we really need to examine is that I can rely on just continuing that same investment plan in retirement. Can you talk about what is different and why we need to stress test and revisit that plan, and whether the traditional investment plan that worked so well in our working career is something that we can rely on into and throughout retirement, specifically for that income plan component that you talked about?
Well, let's consider this option. When you're working, those of you who are still working, you have an income plan. It's called your paycheck. Every week, every other week, whenever you get paid, you got X number of dollars that come into your checking account after you pay taxes, FICA, and all that good stuff, and put away money in your retirement plan. That's your income plan. And as long as you're working, it's kind of serves as a buffer to your investment strategy. Because when you're working, if you have 5 or 10 years to go, you have a little bit of time to make up a loss in the market. When you retire, that whole process is reversed. You no longer have an income. Now you have to rely on your life savings as your employer to give you what you need over Social Security and the pension if you're blessed with a pension. So the investment strategy used getting up to retirement may not be the same investment strategy you could, should, or might use after retirement. Why? Well, the fundamental difference is is that you have to have your life savings produce income now. That may mean you will use different kinds of investments or a different investment strategy to give you the income you need in retirement. On one end, when you're working, you're maybe more growth operated. You want more growth. When you're retired, you need a stable income plan. That's a different mentality. That requires even having an advisor look at maybe investment options that you never realized were out there, or that you never heard about, or nobody ever talked to you about using them to provide income on a steady basis. So it's a really fundamental difference. And so the idea of one of the big myths is that the market always goes up. It does always go up. The market is higher today than it was in 1929. That's a simple fact. That's what, 93 years. The market's higher. You just have to remain upright and alive long enough to experience the uptick in the market. So, folks, ladies and gentlemen, if you lost money in 2008 and you're still working today, you should be a little more comfortable. You may have taken some losses back then, but your money should have grown since then. But if you had retired in 2010 and then suffered a health issue and couldn't go back to work, that's a whole different animal, isn't it? That's a whole different thing to look at. It's like all of a sudden, I don't have any makeup time. I don't even have an alternative. I can't work anymore to bring in extra income. So on a long enough timeline, the market always goes up. On a long enough timeline, we ultimately no longer exist. And it's where those two intersect that's really important. We have to be in a position to create a strategy, an income plan that lasts 25 to 35 years. It's not done just once. It's one that's created today with the understanding that it has to be flexible enough to make changes down the road to adapt. Ladies and gentlemen, if you retired 5 years ago with a bond portfolio that represented 80% of your investments, there's a really good chance if you look hard at your account statements, you're struggling right now. That just indicates that there should have been some adjustments made. That's what we help people do. We create income strategies that on the surface will work, but we also are smart enough to understand we have to manage those. We have to keep our hand on them to make sure that if things change around us, we're able to change, adapt, to do things that'll improve your position, to take advantage of things that are going on, even in a bad environment. So if some of this makes some sense, or you're interested in learning more, ladies and gentlemen, please give us a call, 616-301-2581, 616-301-2581. Go to our website, www.cornerstone-rp.com. We'll help you. So that first myth, the market always goes up, on a long enough timeline, it's true.
However, in any specific period of time, there is no certainty. We don't know. And sometimes those periods of time, Ron, can be extended. I think that anybody who was on the precipice of retirement or did retire in 1999 and then entered into a bear market that lasted about 3 years down and about 4 years to get back up, they face some challenges. They face some angst. Same thing with those that planned on retiring in about 2006 or in the very beginning of 2020 as COVID was hitting. I think that downturn probably worried a lot of people, especially if things had not really been examined and constructed and put together in a way that recognized the reality of down market periods, that we will go through down market periods, that they occur, not only that they do occur, but that they occur more often and more frequently than most of us would like to remember.
Yeah, one of the great articles I ever saw was from Fidelity back in the day. And it was about 2016. And they went back and said, if you'd stayed in the market from 2007 to today, if you'd just stayed in the market with all the 50% downside, you would be up today. You would have more money today than you started with. Therefore, buy and hold, staying in the market is what you should have done. And there's some truth in that. But as most things in the stock market, it's yes, that's true. There's a comma and then but, B-U-T. What if you needed to take money out of your life savings in this period of time? See, the market comes back, and a lot of times what these big institutions do is they never assume that you're going to take money out of the account. They just assume you're going to be there. So yeah, if you left money in the market from 2007 to 2014, that's 7 years, you would have more money today than you started with. Not a lot more, but you would have more. But what if you were retired and had to take money out of that? Then the analysis makes no sense at all. Because if you're taking money out of an account that's going down in value, and if it goes down substantially in value, it's like taking water out of a well that's drying up. It just makes it worse. So one of the fundamental questions everybody has to ask themselves, if I'm going to invest today, this is a key question. If I'm going to invest today, when do I need to start to tap into my life savings for income? When do I need to tap into my life savings for income? If the answer is I need to do it in 3 years versus I don't need to do it for 23 years, you're creating two different investment strategies. If you can wait 23 years before taking money out, you really don't have to be worried about income as long as you can keep working. You just have to worry about navigating the markets as best you can. If on the other hand, you need to take money out of your life savings in 3 years or even 5 years if you retire, that's a whole different investment idea. That's a whole different way to structure an investment income plan, because you can't afford to take a big loss. And yet you can't afford to cut back on your monthly income because you did take a big loss. So it's really two different things to think about. And it's a key question everybody has to ask themselves. When do I need to start to draw money out of my life savings? If you can wait a long time, yeah, you can take on a little more risk if you're comfortable with it. If you need it in the next 3 to 5 years, maybe you need to be a little more conservative with a strategy. Maybe you need to focus more on how do I protect some of my money? How do I create protected permanent cash flow? Those kinds of things. So ladies and gentlemen, I've touched on a really interesting question. When do you need to access the money in your account? Sooner or later, because they require two different approaches. Give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and number in there and we'll reach out to you. We'll get you the information you need. We'll get you whatever you need to do to make really great decisions for your family's financial future.
616-301-2581, 616-301-2581. And Ron, the myth not on your list here, but that we have to take risk in order to make progress. That's something that I think throughout the context of the program today, you have been addressing, maybe not head on, but in stating that there are ways to look at this. There are alternatives and options that can give us progress toward our financial goals where we do not have to take excessive or unnecessary risk. We just have to gauge what those levels are and what goals we are shooting for if utilizing them.
It's really important. Everything has risk. Let me put it in perspective. You can invest everything in some sort of Bitcoin kind of thing, all your life savings. You have enormous potential to make a lot of money. You have enormous potential to lose every dime. Or you can bury your money in a 3-pound coffee can in the backyard. So what's the risk on that? Well, if you go back 5 years from now, inflation will have eaten away at some purchasing power, but you still have your dollars, don't you? So what's the real risk? The real risk is you can develop some sort of dementia issue and forget where you buried it. It's an entire loss then. Every financial decision has an element of risk in it. What's really important is that somebody help you understand or uncover what the real risks are in whatever strategy or investments you want to follow. You know, you can put money in a bank and it's FDIC insured. They're not going to give you, if the banks blow up, they don't have to give you all your money back the next day. So there's risk in everything. And that's what a good financial advisor will help you do. Uncover the risk in your current program plan, and then create alternatives that might be better for you in terms of your goals, but with an understanding of what the risk really is. You can measure risk in stocks and bonds. You can measure risk across the wide variety of different investments. It's important to measure the risk so then you can make a great decision on how much risk do I want to take. So ladies and gentlemen, if you found that this is an interesting question to ask, how much risk is appropriate for you or how much do you want to take? Give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name in there and we'll reach out to you and help you.
Always a pleasure getting the perspective of Ron Courser, CFP, each week here on Your Course to Retirement, Grand Rapids, all surrounding areas. You are lucky to have them as your resource. If you would like to take it a step further and get specific guidance on your situation, they are there to be in touch. Pick up the phone, give them a call, 616-301-2581, 616-301-2581. Ron, always appreciate the time. Another fantastic show. Thank you.
Thank you, Peter, and thank you, everybody listening to today's program. Bless you. Drive carefully. Enjoy the Memorial Day coming up shortly, and give praise to the one who provides everything we need. Take care.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured